introduced. At this time, it is my pleasure to turn the call over to Mr. Patrick Shepard. Thank you, sir. You may begin.
Thank you, Emily. Good afternoon, and welcome to the Advanced Practitioner Series. I'm Patrick Shepard, a lead instructor at OGE's Institute for Ethics and Government. I'm very pleased to be joined today by Ryan Segrist. Welcome, Ryan.
Thank you, Patrick. I'm very happy to be here, too. I am also a lead instructor at OGE.
So, Ryan, what are we going to be talking about today?
So today, we are going to be completing our two-part series on advanced financial instruments. Last month, we talked about a set of financial instruments, and now we are going to talk about some more advanced financial instruments.
So would it be fair to say that we're going to be talking about even more, less common financial instruments?
That's a mouthful, but yes, that's true. When we say even more, we mean more in terms of number, not necessarily in terms of complexity.
Fantastic. Well, today's program is especially timed. It's very timely. What is the significance of May 15th here in the ethics community?
Well, today is the day that financial disclosure reports are due for public filers unless they've been given an extension.
So this is remarkably timely.
You'd think we planned it.
You would, wouldn't you? Well, before we get into the advanced financial instruments, I'd like to take us through some administrative announcements and make an exciting announcement about the end of our program today. First off, you may have noticed that we advertised a number of in-person workshops here at OGE. You may also have realized that those filled up rather quickly. We see that there's a great deal of demand, and we're going to be adding some more dates in June, and then later on in the fall after the Ethics Summit. Additionally, next month we will be hosting our Fundamentals Series and Advanced Practitioner Series as scheduled. In our Fundamentals Series, we will likely be discussing some concepts in public financial disclosure, and in the Advanced Practitioner Series, we should be joined by someone from our Compliance Division to discuss their program reviews and
their new inspection process.
I'd like to just take a second to go over how to ask questions if you have any questions during today's presentation. If you're on the Google Hangout, you will see in the bottom right-hand corner of your screen a text block which will allow you to ask a question. If you have a question, please type it there, and when Ryan or I sees it, we'd be happy to select your question and address it. If you're on the phone, we'd also like to hear your questions, but we're going to hold those to the end. So when we introduce the question period at the end of the presentation, feel free to chime in at that point. We're also very excited because we're going to be introducing a new segment at the end of today's presentation.
We're very excited about this new segment because it's something that we haven't done before, and it's kind of fun, and we think that you'll enjoy it too.
Yeah, this is something that we're going to try and do for all of the advanced practitioner presentations going forward, and we think it's something that will be a little bit of fun, but also very useful to us in our practice and helping us to learn about resources and things that are already available to us.
That's right.
Well, Ryan, should we begin with the disclaimer?
Yes, let us begin with the disclaimer. So, just as a note to everyone who is on the call or in the Hangout today, this presentation is not intended to provide investment advice, and you should not rely on statements in this presentation when making investment decisions.
Actually, I'd suggest that you wouldn't be well served to rely on any statements that Ryan might make when making investment decisions. We have a great deal of ethics expertise, but when it comes to investments, that's not really our business. But thanks for the disclaimer. You want to start with the agenda?
Yes, so here's what we're going to cover today. The first thing that we're going to do is we're going to go over a series of resources that will be very helpful for you in your financial disclosure practice. And then after that, we're going to discuss exchange-traded funds. We're going to discuss mezzanine debt securities, which I know that one sounds very exotic, doesn't it? We're also going to talk about money purchase pension plans and also stable value funds.
Excellent.
And for each of these, what we're going to cover is both the financial disclosure aspect of it and then also the conflicts analysis aspect of them.
And I think it's important, Ryan, you made a point there that we're going to cover the conflicts analysis separately from the disclosure requirement.
Why would we do that, Patrick?
I think it's really important to keep those concepts separate because they are rooted in separate bodies of law and regulation. The public financial disclosure requirements were created by the Ethics in Government Act. The conflicts of interest statutes and regulations we find in Title 18 of the United States Code. As a result, we have two completely separate bodies of law with similar but distinct concepts. To prevent getting confused, I strongly suggest that folks take those two analyses separately. If you're thinking about how to disclose it, think about how it should be disclosed, and then do your conflicts of interest analysis looking at the conflict of interest statutes in Title 18, the standards of conduct, and OGE's other regulations.
This is a strategy that we use at OGE to make sure that all of our financial disclosure analyses are complete and thorough. So let's go ahead and move into some of these resources. The first one that you will see on the next slide is this is a title of Public Financial Disclosure Guide to Reporting Selected Financial Instruments. This one is sort of the advanced textbook. Many of you have the Financial Disclosure Reviewers reference that you use. This one is sort of the next level. It has many of the exotic financial instruments that we have discussed on our previous month's program and also this program, but it has extreme detail in how these things are supposed to be disclosed, what exactly they are and how they function as an investment, and also how to do the conflicts analysis for these.
And again, we take the disclosure requirements and the conflicts analysis as separate sections in the guide. And again, that's to help you keep those two analyses separate to make sure that your disclosure is complete and your conflicts analysis is accurate.
That's right. So we recommend that you download this from OGE's website and make use of it regularly. On the next slide, we also have a list of useful links. If you were to download the slide deck from this presentation, you'll be able to use these links to navigate to OGE's website, the financial disclosure section, and access a number of different resources there.
Yeah, I find that in my practice, I could go years without seeing a mezzanine debt security. And it's really important that I remember that there's a resource available to me to help me determine how it should be disclosed and how I should analyze it for conflicts of interest. So if we only accomplish one thing today, and that is to sensitize you to the resources available and the kinds of things you might find in those resources, I think we will have succeeded.
I agree, Patrick. And with that, should we start talking about exchange-traded funds?
Yes, let's do that. So exchange-traded funds have become more common over the past few years. And again, we have to understand what the instrument is before we can start talking about how it ought to be disclosed and how we should analyze it for conflicts of interest. Ask yourself, have I seen an exchange-traded fund recently on a public financial disclosure report or a confidential report? Okay, so what is an exchange-traded fund? An exchange-traded fund, or ETF, is a fund that pools investors' money in a variety of investments with a goal of replicating the return of a specific index. For example, the S&P 500, the Dow Jones Industrial, or the NASDAQ. Each of these has an index fund that is linked to it. Some of them have many index funds from different providers. Generally, these funds, and sometimes are diversified, while others are focused on a specific sector. If we were having this conversation 7 or 8 years ago, I'd say generally you could assume that an exchange-traded fund was probably going to be diversified.
That's not the case anymore, though, is it, Patrick?
No, these things have become much more sophisticated, and some of them function as quite detailed and specific trading vehicles. So they might be linked to a tiny segment of a small exchange that invests in only a handful of companies. So as such, they would not be diversified. They're actually, in fact, sector exchange-traded funds. So it's really important when we look at our exchange-traded funds to make sure that we get the full name of the fund so that we know exactly what we're talking about. Ticker symbols can be very helpful when we're talking about exchange-traded funds.
That's right, because then you can go to that section on the website of your choice, like Google Finance or Yahoo Finance, and find out more about that fund to make that determination of whether or not it is a diversified or a sector fund.
Yeah, and I think it's interesting to understand the distinction between exchange-traded funds and our more common mutual funds.
How are they different?
Well, the exchange-traded fund functions very similarly to a mutual fund, except rather than trading only at the end of the trading day, an exchange-traded fund has shares that are traded on an exchange that can be traded throughout the trading day. Not particularly important to us as financial disclosure reviewers, but something interesting to note when we talk about the distinctions between the two. So what does that mean for us? How do we report an exchange-traded fund? Well, we report an exchange-traded fund identically to a mutual fund. If a filer holds an exchange-traded fund valued at more than $1,000, or with income greater than $200, we should report the following information on Schedule A. We need the specific name of the exchange-traded fund, and this is very, very important.
This is hugely important.
If you go to the investment companies that manage some of these exchange-traded funds, what you'll find is there are a lot of exchange-traded funds with very similar names. Some of them will be diversified for our purposes, others will be sector funds for our purposes.
For example, on iShares, there are, over 300 of exchange-traded funds, and they just more and more and more keep getting created, and just seeing iShares on a financial disclosure report tells you nothing.
That's correct. And even seeing the name of a broad index isn't necessarily dispositive. You might see iShares S&P 500 and assume that that is necessarily diversified. While there is a fund called iShares S&P 500 that is in fact diversified, there is also a fund called iShares S&P 500 Energy Sector Fund. Knowing the difference between those, or making sure that a fund is one of those rather than the other, massively impacts and affects our conflicts of interest analysis. So it's important to make sure that you have the whole name and that you can distinguish it from similarly named funds. So once we have the name sorted out, the next thing we need to disclose is the category of value. And we would do that in the next block on Schedule A of the Public Financial Disclosure Report. We also want to indicate that the fund is an accepted investment fund. And again, accepted investment funds, or EIFs, are a reporting concept. And they allow us to tick that box, and that means we don't need to disclose the underlying assets. This is not a concept that informs our conflicts of interest review, but it is important for us to do that analysis, and you'll find that your exchange-traded funds are accepted investment funds. We also need to indicate the category of amount of income. So in that block over on the right-hand side of the form, you'll need to indicate what, if any, income was produced by the exchange-traded fund. Because it's an EIF, or an accepted investment fund, the filer doesn't have to report the underlying assets of the exchange-traded fund. That's very good for us, because the S&P 500 exchange-traded funds could have hundreds of assets within them.
Well, it could have 500 or more.
So for any transactions over $1,000, we also have to report the following information on Schedule B, Part 1. We need the name of the exchange-traded fund, the type of transaction, whether it be a purchase or a sale, the date of the transaction, and the category of value for the transaction. The reporting for the exchange-traded funds is fairly straightforward. If you are familiar with the reporting of mutual funds, it's basically an identical process when we get to the actual reporting on the 278.
So you're saying, Patrick, that if we already know how to report a mutual fund, then we already know how to report an exchange-traded fund.
That's correct. The distinction between the two is one of how they are traded intraday or at the end of the day, and for our purposes, that doesn't make a difference when it comes to reporting them on the form.
Do we have some examples of that?
Yeah, let's take a look. So here you can see the iShares Russell 2000 Index Fund, ETF, and we also have the ticker symbol. This is great because we can make sure that that's the complete name of the fund and that we're looking at the iShares Russell 2000 Index Fund and not the iShares Russell 2000 Index Utilities Fund or some segment within the Russell 2000 Index. So having the ticker symbol for these can be extremely helpful. And you can see here that we've reported the category of value. We've indicated that the fund is an accepted investment fund, so we don't need to disclose the underlying holdings, and that it produced between $1,000 and $2,500 in income during the reporting period. You can also see disclosed here on Schedule B a transaction involving iShares Russell 2000 Index Fund ETF, or IWM. We indicate here that there was a sale. It took place on 5/15/2014. And that the amount of the transaction was between $15,000 and $50,000.
So, are you saying that these are two examples of fully disclosed exchange-traded funds?
That's correct. This is a complete and full disclosure of the exchange-traded fund, and this is adequate for the 278. I want to talk a little bit about how these get reported on periodic transaction reports.
Sure.
You'll note, if you attended our presentation or watched our videos about reporting on the periodic transaction reports, that the Congress exempted accepted investment funds from reporting on the periodic transaction reports. So if you have folks who are trading exchange-traded funds during the reporting year, they do not need to report those on their periodic transaction reports, and you would expect to see those on the annual filing on Schedule B.
However, we do encourage, as a way to save work for the filer, putting together their Schedule B for their annual report, OGE does encourage them to over-report accepted investment fund sales and purchases on their periodic transaction reports.
So let's talk about the conflicts analysis for exchange-traded funds. The first thing we have to determine is whether or not the fund is diversified or a sector fund. Why is that important?
That's important because the different exemptions will apply differently to those two different kinds of funds.
Yeah, that's exactly right. So we've changed the analysis that we're doing. We've completed the reporting requirements, which are rooted in the Ethics in Government Act, and now we're looking at a conflict analysis under 18 U.S.C. Section 208.
A totally different analysis.
Which is implemented at 5 CFR 2640. And in 2640 we have a number of exemptions. The distinction between diversified or sector funds is going to tell us whether or not the holdings of the exchange-traded fund are exempted from coverage altogether under 18 U.S.C. Section 208, or if we have to look to a de minimis. So we want to think about those, the sector versus diversified and the exemptions that might apply.
I have a question, Patrick.
Sure.
So in 2640, it says the exemption for diversified mutual funds and for sector funds. It doesn't say anything about exchange-traded funds.
For our purposes, exchange-traded funds are either diversified mutual funds or they are sector funds. So we treat them exactly as we would for mutual funds. They are registered slightly differently, they trade differently, but the exemptions apply equally to exchange-traded funds as mutual funds. So how do we determine if an exchange-traded fund is a diversified fund or a sector fund? Well, the first thing we have to look at is the stated investment policy of the fund. If the fund has a policy of investing in one sector within the economy, one country outside of the United States, or the bonds of one state within the United States, it is a sector fund. If it has no such stated policy, then it's diversified, and we can use the exemption for diversified mutual funds. If it's a sector fund, we have to consider the de minimis that is available for sector funds. So in either case, we're going to be looking at some exemptions. We just want to make sure that we're looking at the correct exemption.
Right. So the next one that we're going to talk about are mezzanine debt securities. And what the heck is that? I mean, I grew up on a farm, and I don't know that I've ever even actually been in a mezzanine. It sounds really esoteric, but it's pretty easy. So let's break down what the different words in mezzanine debt securities means. So the word mezzanine refers to the debt service priority that a company has. So let's say that a company is going to be liquidated. There's senior debt, which gets paid first. Then you've got mezzanine debt, which is paid next with whatever's left, and then you fulfill the common stock after that. So all it is just an indication of where someone would get paid if a company is liquidated or other circumstances happen. So the debt security part of that just means that it's a note that's linked to the future profits of the issuer. So for example, if Google were to issue mezzanine debt securities and Patrick was to buy one, then he would have a note that is linked to the future profits of Google. And Patrick would be assuming that the company will make more money in the future and that he will get more money back than what he put into buying that debt. Now, because these are negotiated instruments, there's no market for trading them. And the negotiations often include the option for the company to delay repayment, and also often include options or warrants that would allow the purchaser of one of these debt securities, allow them to purchase securities of the issuer at a higher price in the future. So far, so good?
Good. Yeah, I think that makes sense.
Okay, so let's go ahead and talk about the disclosure side of it first. So the main things that we need in order to disclose a mezzanine debt security is we need to know the name of the issuer and an indication that the asset is in fact a mezzanine debt security.
Okay.
Because if you just say Google,
we don't know what that is.
Right, we're going to think that probably that it's stock.
Yes.
But it could be senior debt or it could be a mezzanine debt security.
So this is another case when we want to make sure that we have completeness.
That's right, Patrick. That's right. If we don't know that it's a mezzanine debt security and we don't ask, then we could have some problems later on. We also need the category of the asset value. We need any income from it and the type, which is usually going to be interest payments. And we also need to know if there are any related securities that meet the reporting threshold, such as a warrant or an option or other equity interests, reported as a separate line item.
So those warrants are sort of attendant to the mezzanine debt security, and we would look at those separately for our conflicts analysis.
That's right.
Okay, so those are reported separately, and we're going to treat them separately. That makes sense to me.
Mm-hmm. So, and there are also Schedule B reporting requirements, which are similar to every other Schedule B reporting requirement.
So we just need the transaction, description of the transaction, the type, the date, and the value of the transaction, just like for any other security.
That's right.
Excellent.
So on the next slide, we have an example of how these things are supposed to be disclosed. So you can see here that we have a Google Inc. mezzanine debt security, which is written down. We have the category of value. We have an income at the far right and the income type. And I'm sorry, that should say interest. It got cut off on the slide. And we also have under that a warrant for unvested Google Inc. stock, which means that if I was the holder of this, mezzanine debt security, I also hold a warrant that would allow me to purchase Google stock. I would be able to purchase 100 shares at $100, and that this warrant will expire on December 1st of last year, or this year.
Excellent. Well, that's very interesting. So that's almost like an option or a right to buy at some future date.
Right. So warrants are a kind of option, and they're reported the same way.
Excellent. Well, that's very helpful, and I see why it's really important for us to separate those out so that we can do separate analyses.
That's right. So let's go ahead and talk about the conflicts analysis for these. So the first question that we want to ask is, what about the issuer of the mezzanine debt security to begin with? And this is actually an easier analysis than what you would think. It's easier than most other debt instruments. So basically, where do you think the conflict is going to lie? It's going to lie with the issuer of the mezzanine debt security. So on that previous example, that Google Inc. mezzanine debt security, the conflict is going to lie with Google Inc. because they were the ones who issued it. So a person who owns that can't participate in matters affecting the financial interests of Google Inc. The other thing that's kind of nice about this that makes the analysis easier is that there are no exemptions for these things. Like I said in the definition of this, these are negotiated instruments and there's no market for them, so they can't be publicly traded like stocks are.
So the analysis here is distinct from our stock analysis in that stock is usually publicly traded or can be publicly traded. But these mezzanine debt securities can never be publicly traded because they're negotiated, so therefore we don't have the exemptions available.
That's exactly right, Patrick.
Well, that simplifies things a bit.
Yes, it does. And the last question that we have on here is there something that we should always do whenever we see these, even if you only see them once in your career. And the thing that you need to do is to always ask your filer if there are any other interests in the entity that issued the mezzanine debt security that would require a recusal. And the reason why is because if there are any other interests, eventually that entity will pay off the debt, pay off the mezzanine debt security, and then the filer may still have, say they have stock somewhere else, some other stock in the company.
So what you're saying is that mezzanine debt securities also indicate that there may be some residual interest that outlives the debt security after that debt is settled?
No. What I'm saying is that a separate interest in the company, for example, a separate stock interest from the mezzanine debt security, because the debt security will eventually go away on its own.
Excellent. So I understand. So the company might pay off the debt security, but I may be left holding shares that I own as a result of this mezzanine debt security, like maybe by exercising a warrant or something like that.
That's right. Or you may just have had them to begin with.
Or I may have had them to begin with. So if we see a mezzanine debt security disappear from year to year, we may ask about any equities that were related or unrelated to that may have persisted.
We must ask.
Excellent. Well, that's very helpful to know.
So, would you like to talk about money purchase pension plans?
I would love to talk about money purchase pension plans, which is quite the mouthful. I think the hardest part of money purchase pension plans is saying money purchase pension plan. A money purchase pension plan is a type of defined contribution plan. So when we're talking about defined contribution plans, can you think of some other kinds of defined contribution plans?
How about a 401k?
Yeah, a 401k, maybe a 403b. These are tax-deferred retirement accounts where an employer and an employee make periodic contributions, and then those contributions are invested in some underlying securities. So unlike profit-sharing plans in which the employer contributes are discretionary, like a 401k maybe, employer contributions to a money purchase pension plan are fixed in advance. Each year, the employer must make fixed contributions based on employees' annual compensation. But very much like other defined contribution plans, money purchase pension plans have underlying assets in which the filer has invested. So we're going to be able to use a lot of the information that we employ when we're looking at things like 401ks that we're very familiar with when we look at the money purchase pension plans. These assets often include the underlying assets of the pension plan: annuities, diversified mutual funds, bond funds, and stable value funds. So if you're not familiar with the conflicts analysis for those kinds of holdings, you're going to need to become familiar when you analyze the underlying holdings of your money purchase pension plan. But before we get to the conflicts analysis, let's take a look at the reporting requirements for the money purchase pension plan.
Because the disclosure analysis is separate from the conflicts analysis.
Right, and when we're talking about public financial disclosure, it's good to make sure that we have something fully disclosed in accordance with the Ethics in Government Act, and then apply the criminal conflict of interest statutes and OGE's regulations to determine if we have a potential conflict or other ethics problem.
Mm-hmm.
So let's take a look at this. How do we disclose a money purchase pension plan? If a filer has an interest in a money purchase pension plan valued at over $1,000 or with income greater than $200, they should report the following information on Schedule A. The name of each asset of the plan that meets the reporting threshold. These should be reported as separate line items. So this is just like we do with our IRAs, our 401ks, and our 403bs. We have to break out the underlying assets. A money purchase pension plan is never going to qualify as an accepted investment fund. I'll say that one more time. A money purchase pension plan will never qualify as an accepted investment fund, so therefore the underlying holdings, where they meet the reporting threshold, must be disclosed. For each of those items, we must disclose the category of asset value for each listed asset, the type of income for each asset listed, or an indication that the asset is an accepted investment fund. So the underlying holdings of these money purchase pension plans may individually qualify as accepted investment funds. Say, for example, one of them were a diversified mutual fund or even a sector mutual fund. If they meet the definition of accepted investment fund, we needn't break them out any further. But at the top level, the money purchase pension plan itself will not qualify as an accepted investment fund.
And that's similar to other defined contribution plans like 401ks and 403bs.
In fact, it's very common in these kinds of plans to see that someone holds a number of accepted investment funds in the form of mutual funds or other kinds of pooled investment vehicles. We also need the category of amount of income for each asset listed. If an asset in a money purchase pension plan is a fund that does not qualify as an accepted investment fund, the filer must report all of the underlying assets of that asset. So just because the money purchase pension plan doesn't qualify for an EIF doesn't mean that every pooled investment vehicle within it will qualify as an EIF. We have to keep breaking those out until we reach a holding that is itself an accepted investment fund.
That sounds like that can get very complicated, Patrick.
I'm not sure if it's complicated. It can just be time-consuming, and the reporting requirements can be quite onerous in some cases. When you're dealing with the money purchase pension plans, however, normally the holdings of these investment vehicles are things that we see all the time, like mutual funds and the like. So you often get to EIF quite quickly, much like you find with your typical 401k, 403b, IRA, or similar defined contribution plans. We also have some Schedule B reporting requirements. For transactions over $1,000 involving any asset of the money purchase pension plan, the filer should report the following information on Schedule B Part 1. A description of any transaction associated with the asset of a plan. So if we had within the plan, say stock in a company, and we sold some of that stock within the plan, we would have to report that transaction on Schedule B of the report, even if it was within the money purchase pension plan. This is equally true for those transactions that would be reportable for periodic transaction reporting. So if the underlying asset is subject to the periodic transaction reporting requirement, it must be disclosed on a periodic transaction report, notwithstanding the fact that that asset is held within the money purchase pension plan. So much like 401ks, we're not particularly interested in the fact that these assets are held within the money purchase pension plan. We're primarily concerned with the underlying holdings. When we report these transactions, we want to be sure to include the date of the transaction and the actual value of the transaction. So once we get below the level of the money purchase pension plan, we treat each of these assets just as we would if they were reported anywhere else on Schedule A or Schedule B of the form. And we have to be familiar with the disclosure requirements for those underlying assets and the conflicts analysis for each. So there's some more information that we have to disclose for the money purchase pension plans. And this, again, much like other kinds of defined contribution plans, goes on Schedule C Part 2. Because this isn't an agreement or arrangement from previous employment. We need the name of the employer. We need the type of retirement plan, which in our case will be money purchase pension plan. We want the date at which the filer began participating in the plan, and an indication as to whether the employer continues to make the contributions. Usually the answer to that's going to be no.
Mm-hmm. What about if a filer's spouse has a money purchase pension plan?
That's an excellent question, Ryan, because you probably know that on Schedule C Part 2, we're only reporting agreements and arrangements that apply to the filer. So if the spouse has a money purchase pension plan, the reporting requirements are unchanged on Schedule A and Schedule B Part 1, and for purpose of the periodic transaction reporting, but we don't need an entry on Schedule C Part 2 because it applies only to the filer and not a spouse or dependent child.
That's good to know.
It is good to know. And it's nice that we don't have to have that information for family members of the filer.
Mm-hmm.
Our conflicts analysis is still going to be very similar. We're going to look at the underlying assets of the money purchase pension plan, regardless of who owns it, and determine whether or not any of those pose a conflict.
Do we have an example?
Yeah, let's take a look at an example of the disclosure of a money purchase pension plan. So in this case, we have a Google Incorporated money purchase pension plan. Within it, we have some Google stock, the S&P 500 Index Fund, the Ridex Health Industry Fund, and the Vanguard Bond Fund.
You're right, Patrick. This looks like an awful lot of defined contribution plans I've seen.
Yeah, you often find that you have securities in the organization or the employer. So that's always a good question to ask, because while generally, if no further contributions are being made, whoever sponsored the plan or set the plan up initially isn't a great concern to us. If securities from that employer remain in the plan, it's important for us to know that because that changes our conflicts analysis. And you can see we've broken out each of the underlying holdings on individual lines, just like we would with a 401k or an IRA. We have for each of those indicated a category of value. We've indicated whether or not they're accepted investment funds. If they are not, we've indicated the type of income, and then we've introduced and reported the category of income amount on the far right there. So again, if they're held within a money purchase pension plan, the reporting requirements remain the same for a stock, a fund, or any other holding. So you want to be familiar with the reporting requirements for the underlying holdings. You can see also here that we have the entry from Schedule C Part 2. We indicate that no further contributions will be made. We have the date that the plan was entered into and the parties to the plan. So how does our conflicts of interest analysis work? When we're conducting a conflicts analysis under 18 U.S.C. Section 208, we're primarily concerned, or exclusively concerned, with the underlying assets. So we look at the underlying assets of the plan and we conduct our conflicts analysis vis-a-vis each of those. So if they're diversified mutual funds, we may have exceptions available. If they're sector funds, we may have some de minimis exemptions available to us. If they're publicly traded securities, we may have the de minimis available to us. But we analyze each one of those independently, and we determine whether an exemption might apply to each of them as individual holdings.
What about if the employer is still making contributions to this plan?
If the employer continues to make contributions, we may have a number of concerns. We'd be concerned with the employer's ability or willingness to continue to make those contributions. We want to make sure we didn't have any supplementation of salary issues and the like. That's a very uncommon situation, but it's certainly a question you want to ask because it could change your analysis a bit. We mentioned a little bit earlier the stock in a former employer and how that works. Well, obviously, if the employee has stock in the former employer, we're going to have to do a conflicts analysis with that security. It may qualify for a de minimis exemption, it may not. And if it doesn't, we'll have to alert the employee that he or she should recuse under 18 U.S.C. Section 208 from participating in any matters that would affect the company. You also, when you see these plans that result from previous employment, find out when they left that previous employer. Make sure you know that, because they'll have a covered relationship for a year under Subpart E of the standards, after they left the employer, and if they're pledge signers, that gets extended to 2 years, so you may have an additional recusal requirement.
So the next one that we're going to talk about is called a stable value fund. And a stable value fund is an investment vehicle that's usually offered as an option that people can pick in an employee benefit plan or an employee retirement plan. And the purpose of these things is they seek to have greater returns than a money market fund, but have greater security than your average mutual fund does in the market. And these things usually, their underlying investments are going to be in bonds or in interest-bearing contracts that are held by insurance companies that agree to pay them a certain amount over time. The main thing with these is that some of these are registered with the SEC. Why do you think that's important, Patrick?
Why is it important that they be registered for the SEC? Does that impact our conflicts analysis and the availability of the exemptions?
It does, because if they are not registered, there is no exemption available.
Well, I could imagine that being quite the pain.
Yes, it would be. It would be. So just remember that some of these are registered with the SEC and that not all of them are.
So we would need to check to find out if a stable value fund was registered. Does the SEC maintain a database of records that we might be able to find out if they're registered, or do the investment companies usually tell us whether or not they're registered?
The investment companies will tell you on their prospectuses, they're required to tell you whether or not the fund is registered under the Investment Company Act of 1940, which is the important act in question here. And you can also go to the SEC's website. They have a database called EDGAR that you can search for documents.
I think I remember doing this one time. I opened the prospectus and it was a PDF that was about 80 pages long. Knowing that number 1940 was really important because I could go Control F, type in 1940, and find the area where they disclosed whether or not they were registered quite quickly.
That's right. That's a trick that I use as well. So before we get into the conflicts piece, let's do the disclosure piece first. And our main question for this is a stable value fund going to be an accepted investment fund or not? Now, remember that accepted investment funds are independently managed, they're widely held, and they're publicly traded or available or widely diversified. Stable value funds are usually independently managed because oftentimes the folks who manage these things are another company, or they are people who have their own sort of executive compensation packages. They are also usually widely held because they're part of retirement plans. They are often also publicly available, and this is going to sound strange for a moment. They're often publicly available even when they're not open to individual investors. And they're considered publicly available because they're open to institutional investors like employers. So for example, if Google had a stable value fund and Patrick does not work for Google, does not have access to it, and says, I want to invest in the stable value fund, they would say no. But if another company wanted to invest in the same stable value fund as Google does, then they could do that.
Is that because investment houses and companies that make investment vehicles available to people and organizations sometimes structure special products just for corporations or other employers?
That's right.
So if it was available to a number of employers, we could say that that was publicly available for purpose of the EIF test?
That's right.
Excellent. That's very interesting.
So the conclusion is they are often accepted investment funds. There are exceptions, of course, but oftentimes they are. So let's see how we disclose these on a 278. So here is an example of how you disclose a stable value fund, which you disclose it the same way as you would disclose a mutual fund, or you would disclose an exchange traded fund. You need the name of the fund and you need the category of the value of it. They're usually going to be EIF, and you also need the amount of income that was made from it. Now just remember that if it's not an accepted investment fund, you would then have to break out all of the underlying holdings that are held in the stable value fund. A couple of other things. You also need to report these on Schedule B, Part 1, the same way as you would a regular mutual fund. And also, if this stable value fund is part of a retirement plan or an employee benefit plan, you need to report that on Schedule C, Part 2. So the conflicts analysis for these can be very easy or they can be very hard, depending on whether or not it qualifies as a diversified mutual fund. If it's registered under the Investment Company Act of 1940, it meets the definition of a mutual fund for purposes of applying our exemption.
So does that mean, Ryan, that if it was diversified, we would have the exemptions available for diversified mutual funds? Or if it was a sector fund, we would look at the de minimis?
That's right. That's exactly right. If it's not registered, if it does not meet the definition of a mutual fund for our purposes, then the analysis can get a little more complicated. Our filer cannot participate in any particular matters affecting the fund itself, issuers of the underlying securities, or affect the ability or willingness of bondholders or interest-bearing contractees to pay the obligations into the fund.
Interesting. So that's quite a difference, whether it's registered or not. So the first question we're going to have to answer is it registered? Because we're either going to have a relatively simple analysis like we do for a mutual fund, or a more complex one.
That's right.
And I think this is one of those areas where it's really good to have available to us the resources. Because Ryan said that very clearly, but I'm sure 6 months from now when I see a stable value fund, I probably aren't going to remember that. So if I'm not going to remember that, I need to know where to find the answer, and the answer is in our book of less common financial instruments or select financial instruments, where I can find that information.
And you can also find even more information about all of this stuff on those links that we had on the third slide.
Yeah, so the resources are very important, but it's also good to know that there are special things we need to know about these kinds of assets and holdings. I think we do have one question from the internet, Ryan. Let me read it to you, and we'll see if we can take care of this. So the question is, what does a mezzanine debt security look like on a financial statement? Filers don't usually understand what they own, so what question should I ask to identify a mezzanine debt security?
Well, I think the answer to that question is you just have to ask whether or not, the thing is they're going to have on their financial statements, they're going to have entries on there that indicate that they hold the debt of a given company. And you just need to ask your filer whether they hold senior debt or mezzanine debt. And if they don't know, then they have to call up the company and find out.
That's very interesting. And then we'd also want to follow up with that warrant question, whether there were any attendant or resultant securities that they held that they should also disclose.
That's absolutely right.
And this is always a challenge that we run into with the reporting requirements. As filers, sometimes someone else takes care of their investments, and it can be difficult to suss out exactly what they hold, and sometimes you have to go back and forth a few times.
Mm-hmm.
I think the important thing here is to know that mezzanine debt security is a thing, it's a possibility, and if you see something that looks like a mezzanine debt security, to clarify either that it is one or it is not one, and again to ask about those warrants.
That's right. And remember that the basic question, the basic thing that they're going to see on their financial statement is that they hold debt in a certain company.
Okay, so if you see a debt reported, commercial debt reported on a form, you might want to check and make sure that it is or isn't a mezzanine debt security.
That's right.
Okay. We'd like to go ahead and open it up on the phones to see if we have any other questions.
Thank you, gentlemen. At this time, anyone wishing to ask a question or make a comment, please press star 1 on your touch-tone phone. Please be sure your telephone is unmuted and clearly record your name when prompted so your question may be introduced. Once again, it is star 1 to ask a question. One moment, please.
Thank you.
Our first question comes from Shara Minton. Your line is open.
Hi, I'm asking a question about slide number 22 because I'm not sure if I missed it or you didn't cover it, about whether or not the stable value fund could be, we could take advantage of another exemption for a stable value fund, including the employee benefit plan or some other exemption. Thank you.
Oh, thanks, Shira.
Hi, Shira.
Hi.
So if the stable value fund is if it's part of an employee benefit plan, you could use that exemption for it, the employee benefit plan exemption.
That can be really helpful, right, Ryan?
Yeah.
Sometimes you see it and you go, oh no, the mutual fund exemptions aren't going to apply, and then you find that the exemptions for employee benefit plans are available, and you are massively relieved.
Yes.
Yeah.
Yes, exactly.
No, so that's exactly right, Shira. Thanks, that's a really good question, and a good thing to clarify for everyone.
Thank you.
Thanks.
Thanks.
Thank you. And once again, if we have anyone wishing to ask a question, it is star 1. One moment, please. And gentlemen, at this time, I'm showing no questions.
Excellent. Thank you, Emily. Well, that's very exciting. Thank you for those questions. They're really good ones, and it's good for everyone to get clear on that. But that does bring us to the very exciting part of today's presentation, and that is the new segment.
Dun dun dun!
So Ryan, what is the new segment?
So this new segment is called the Archive Dive, Patrick.
What exactly is an archive dive?
So the Archive Dive is a thing that we're going to do every month at the Advanced Practitioner. What we're going to do is we're going to ask you folks out in the ethics community a very difficult question related to the history of ethics law and policy.
So we're going to look for lessons from the history of our laws and regulations that can make us better in our practice as ethics officials.
That's right. That's right.
Well, that sounds like an awful lot of fun. What do I get if I'm the first to answer the question? How would I go about answering the question?
So the first thing is if you know the answer to the question, or you find the answer to the question, what we'd like you to do is to go to the Max page where you registered for this course and put the answer down in the comments. And if you have a link to the web, please put that in there too.
And what do I get if I'm the first one, Ryan?
Nothing.
I get nothing. That's not very good.
Actually, that's not true, Patrick. You will get the admiration and respect of all of your colleagues in the ethics community for getting it right first.
Well, I'm very much looking forward to getting the admiration and respect of all of my colleagues in the ethics community. So do we have a question today?
Actually, one other thing. We also will announce the name of the person who gets it right first on next month's Advanced Practitioner.
Well, that's pretty cool.
Yeah, so you will get recognized.
Fantastic. So what's the question this week?
So, in 18 U.S.C. Section 208, the words direct and predictable do not appear.
That's right.
But they do appear in the implementing regulation in 2640.
Who are we, Congress?
No. But here's my question, is where in ethics law and policy history do the words direct and predictable first appear in relation to federal conflicts of interest law?
Okay, so let me make sure I understand. We're looking for the term direct and predictable employed in the United States with respect to potential conflicts of interest and government employees. And we're looking for the first instance?
That's right.
Well, it's not looking good for me earning the respect and admiration of my colleagues this month.
It's a stumper, isn't it?
That's a bit tough. Well, that's a really good question. I look forward to joining you next month to find out what the answer is. And I hope you guys look forward to finding out the answer. If you know the answer, that's fantastic. We'd love to recognize you. And we think that will be a useful thing in our implementation of 208. So until next time, I'm Patrick Shepard.
I'm Ryan Segrist.
And we'll see you next time on the Advanced Practitioner Series.
Have a great day.
This does conclude today's conference. Thank you so much for joining. You may disconnect at this time. And